squeeze on household incomes is going to be the big story of 2022.
Because before the financial crisis, bank rate hovered at 4-5%. Is that where we're heading back to?
All evidence suggests this is just the start.
The scene will be familiar to most parents. You're travelling with your children, waiting for the inevitable question, are we nearly there yet? Well, at least that's what my 7-year-old daughter always asks. And I find myself asking the same question today. We've seen significant declines across both equity and fixed income markets. So are we nearly there yet? I think not quite.
The Bank of England says the UK economy is in for another tough few months.
As I've mentioned before, we're in a period of profound regime change. In recent years, we had quantitative easing, which pinned rates at zero and really forced investors up the risk curve in a desperate search for yield. And this basically suppressed volatility across markets and meant that any concept of valuation was thrown out of the window.
We intend to raise the key ECB interest rates by 25 basis points at our July monetary policy meeting.
But now, as central banks rush to raise rates to cope with high levels of inflation, the game has fundamentally changed. For now, central banks are going to prioritise the need to bring down that cost of living on the high street and won't be as willing to support markets. So expect volatility to continue. And we need to recalibrate our expectations for valuations.
The market is not convinced, despite the sharp sell-offs that we've seen, it's not convinced that we've quite reached that bottom. And for that reason, we're seeing investors starting to look at bonds again.
The good news relative to the beginning of this year is that valuations have improved. And in particular, we are starting to see some value in government bond yields, which offers some protection against recession risk as well. However, we need to be alert to the risk of inflation persisting for longer than we're expecting. And in equities, we're concerned that earnings expectations have not adjusted enough for the potential risks to growth. So all in all, valuations have improved, but they're not at levels which are so provocative that we can just shut our eyes and ignore the risks.
The worst is yet to come. The Bank of England believes the squeeze on our living standards will be so severe that it's forecasting a recession.
So we see rising interest rates and growth concerns, meaning that valuations need to be recalibrated. And against this backdrop, I thought it would be useful to share some lessons from previous bear markets. First of all, you can actually get some of the strongest rallies in the midst of bear markets. The reality of bear markets is they are quite volatile. So either ensure you have the decision-making processes to make those dynamic adjustments or diversify your portfolio to reduce the risk of getting whipsawed. Secondly, and on a brighter note, right now we're in the midst of that valuation adjustment. But as that recession risk gets more priced into markets, we will see major valuation opportunities. So again, you need to be ready to take advantage of those opportunities as they emerge. And finally, in the midst of bear markets, often you can make very expensive mistakes. So ensure you don't lose sight of your strategic plan, invest in the resilience of your team, and make sure you don't oversteer. So hopefully next time you see me in the CIO Lens, we'll be moving from are we there yet to where next?